The late March sell-off dragged the Nifty 50 down to a weak, exhausted phase around 22,331. If you were trying to trade this index right now, you already know how erratic the intraday swings have become. Pure price-based technical analysis struggles in this environment. In a rotational market, obvious support and resistance levels are routinely pierced to trap breakout traders before the price sharply reverses direction. To navigate this chop, we have to look beyond price. The methodology developed by W.D.GANN operates on a specific premise. Measurable time cycles dictate market reversals with higher reliability than horizontal price levels alone. When a specific date arrives, the trend is forced to make a decision. Today, we are going to map the exact geometry of the Nifty 50. I will walk you through the macro weekly boundaries, pinpoint the precise upcoming daily GAN turning window, and give you a mechanical three-part trade plan to execute when that window opens. Before we start mapping, open up your own charting platform. You will want to draw these specific levels on your own screen so you can track the price action in real time as the week develops. Survival in an exhausted market requires patience. We have to stop trying to predict random price movements and instead learn to react only when time and price converge. Step 1 is zooming out to the weekly chart. We must define the macro boundaries of the current trend before we even think about hunting for daily entries. This chart shows the primary overhead supply zone. We draw a strict horizontal band between 22,600 and 22,800. This ceiling caps the market, keeping the broader bias bearish. Directly below that, we map the critical weekly support floor. Buyers consistently step in between 22,000 and 22,300. But if bulls fail to defend that floor, the immediate downside risk drops straight to 21,800. Our bearish bias remains valid as long as the price stays below our upper band. To confirm a true macro bullish shift, we need to see a definitive weekly close back above 22,800. The weekly structure proves the Nifty index is currently trapped in a high-risk squeeze between two heavy levels. Timing the exact breakout is the only way to avoid getting caught in the chop. Now that our boundaries are set, we shift focus down to the daily time frame to apply the GAN time cycles. This daily chart shows our highest probability time cycle turning window. According to the GAN cycle cluster, the target zone runs from March 31st to April 5th, 2026. Inside that block, we have an early warning window spanning March 31st to April 1st. This is where downside pressure is mathematically expected to peak and exhaust itself. Because the market is already sold off, we look for a rebound from an oversold base. We want to see price drop into our vertical time box, strike the 22,200 support floor, and print a bullish reversal candle. Any daily bounce out of this zone immediately faces a lower time frame resistance hurdle between 22,450 and 22,500. The reversal is only valid once it clears that hurdle. GAN timing dates are probabilistic windows. They tell you exactly when to watch the market, but they do not dictate when to blindly buy. You still need to wait for price confirmation. A mapped chart requires a mechanical execution plan. To remove emotion from the equation, we prepare for 3 specific scenarios. Plan A is buying the reversal. We trigger this entry only if we get a bullish daily close or a strong intraday recovery, off the 22,200 to 22,400 zone, entirely inside our GAN window. Our targets are 22,800 and then 23,150. The strict stop loss for Plan A is a daily close below 22,100. If the price closes below that line, the GAN cycle is invalidated and the setup is dead. Plan B is selling the breakdown. If the time cycle fails to generate support, we follow the trend downward. The entrant triggers on a decisive daily close below 22,600, targeting 22,400, 22,200, and eventually 21,800. The stop loss sits securely above 22,800. Resist the instinct to guess the bottom. Plan B only activates when the bears prove their strength with a weak daily close. Finally, we have Plan C, the no trade zone. If the Nifty oscillates in the choppy band between 22,600 and 22,800, traders are mathematically favored to lose money. Professional survival relies on discipline. You simply wait for the market to trigger Plan A, Plan B, or trap itself in Plan C. We now have a unified chart. The horizontal price levels and the vertical time cycles create a perfect crosshair for the upcoming week. The primary failure point for amateur traders is anticipating the date and buying early. You must wait for the daily close confirmation to prove the reversal is real. Strict capital protection is non-negotiable. Control your position sizing and honor your stop losses the moment the price action violates your setup. Please read this SEBI disclaimer carefully. This video is for educational purposes only and does not constitute financial advice. Always perform your own due diligence. All technical analysis is an exercise in probability management. Your chart is mapped, your parameters are set, and your April trading window is about to open. Trade the plan.